So what's up? Anything new in the market? How do you feel? We will get started with the regular discussion, but let me just get the temperature of the room. Meanwhile, anyone joining here for the first time? Any first timers here?
Hey Vivek, yeah, this is Deepu here. I'm joining for the first time.
Hey Deepu, welcome. What brings you here?
Well,
And would
my
like to know a little bit about you as an investor.
one of my friends, he just sent me the invite, and I thought I'll definitely join to learn from you and from other guys about the market and what's going on right now. A lot of uncertainty going on. December usually the best month, and now we are seeing a lot of uncertainty because of Bank of Japan and all that. So just wanted to know all this, your opinion on that.
Oh, okay, cool. And what kind of investor are you? Are you like long-term investor, day trader, swing trader, zero DT options?
It's a mix of all, actually. I have a long-term portfolio as well, but
Okay.
other than that, I do the zero DT day trading as well.
All right. So you're covering the whole spectrum.
I
Both
try to,
sides.
but
Okay,
it's
cool.
hard to master everything.
Okay, cool. Cool. All right, welcome. And thank you to your friend who shared this meeting with you. The more the merrier, we learn from each other. And that's what the whole purpose of these Saturday morning discussions are. Anyone else here for the first time? Uh, Derek, uh, I maybe maybe it sounds to me like a new name. Derek Jones. Hey, Derek, are you here for the first time, or maybe I missed you earlier? Okay, he may be shy. Who else? Jay, I know James, Jose, Matt, Melody, Nyanka, Ramesh, SR.
Hey, hi. Yeah, this is Soha, and I did attend last time, Vivek.
Okay.
I am just new to this whole world of financial stuff, and so I just want to hear and learn.
Oh, okay, okay. Sorry, maybe I missed your name in the previous meeting. But welcome. Uh, so we only focus on investing because at least I don't focus on anything else financial. So you said financials, which is a very broad topic. Uh,
Yeah, I'll see. So I'll listen in when I can, and if it's not a fit, then I'll drop off.
Okay. No, no, it's entirely up to you. So we just focus on personal finance and investing side of those.
Yeah,
Not,
yeah. I'm
no,
just trying to learn overall all the
got it.
areas.
Got it. Got it.
It was
Cool.
very helpful last time, by the way. Thank you.
All right, you're welcome. All right. So today my plan was to look at uh, the top one topic from our previous session, which was break-even revenue valuation, um, especially when the future is unknown. So how do you, I mean, there are various methods of how do you value a company. One of them, which I recently gone through the video of Professor Damodar, who's known as the Dean of Valuation, where he talked about the concept of break-even valuation. So I had earlier talked about Michael Mauboussin's concept of expectation investing and how a reverse DCF came from it. This is kind of a similar to reverse DCF, but not exactly the same. So we couldn't cover it in the previous Saturday, so I want to at least make sure we cover that in today's session. And then, of course, at a macro level, we'll talk about what happens in FOMC, meeting, and got some interesting charts, some corporate news, any other stocks you want to talk about. We can look at that and a little bit on the crypto side. What happened additionally this week on crypto? Yeah, that's much. Which we are half. We're only what 2 weeks away from closing this year, and so far so good. Market has been pretty good, and I don't know if we get a center rally or not, but we'll see. Taking it easy. It's a holiday season, so not. I think this probably is the today may be the last session with some heavy content. Next week it's going to be a little light on our heads. So that's the agenda for today. Unless you guys have anything else in mind. Any new stuff you saw in the market you want to talk about?
Hey, Vivek, I would definitely like to know about the Bank of Japan. They are going to increase the rates. That's a lot of expectation, and market is, I think, in dilemma right now. So maybe whenever you get time after the session, just if you can brief about that, that would be helpful.
Sure, yeah, we can talk about it. I mean, all right, so BOJ, let me take a note of that. BOJ rate hike. All right, well, okay, cool. Okay, so let's start with today's session, our discussion number 303, almost 5.5 years. And hopefully if you continue to attend, I'll continue to, conduct these sessions. We'll have so much fun doing it. I learn a lot from you guys. So as always, this is only for learning. Please don't take it as investment or tax or financial advice. You're all here to have some little bit fun. Spend this week, spend a few hours every Saturday to become better as an investor. Okay. So I always want to start our discussion with some thoughts, some food for mind. One thing which I want to talk about is the book that I just finished reading, and which is Big Mistakes. I think did I mention it last week that I will be starting on this one? It's such an interesting book that, I don't think I've ever been able to finish a book within a week, and it's not too big anyway. So I think it's around 200 pages. So I was able to finish it. A very interesting book written in a very lucid language, not heavy on the head and not heavy on your brain. So was able to finish it. If time permits, maybe I'll give you a summary of this one. Otherwise, next week, my idea was maybe next week I'll cover the summary from this. This book basically talks about the big mistakes of the best investors, right? And the idea was to learn from the mistakes of so-called, the investors that we worship, Benjamin Graham, or if you are a speculator or short seller, then Jesse Livermore from 1929, who made $100 million when the 1920 market crashed from 1929 to 1933. Talked about Stanley Druckenmiller, talk about um, even Warren Buffett. So it's always good. I mean, learning from your own mistakes, everyone has to pay tuition fee to the market. We all learn, but it's better if we can learn from someone else's mistake. So I finished that one. And I want to give you homework today, and we'll come back to this topic later on. Maybe next week, we'll discuss this. So you have a week to think over. Look into your portfolio and pick 2 stocks that you feel have given you some good returns. Pick whatever you want. I really don't care which stock you pick. But then come back and tell me the stock and basically share with us. And the stock benefited you because you think you had a skill in identifying the stock, or you got benefited because you were lucky. Right? Because investing involves both the concept of skill as well as luck. There will be many smart investors who have taken academically some of the best decisions in identifying the company, but market just didn't agree, or market took too long to agree with them and they didn't turn out really lucky. Whereas on the other side, your neighbor, my neighbor, doesn't care about the markets, haven't looked at the markets anytime, just picked up on some subreddit saying, oh, let's pick this Palantir, and they bought at $7 and now it's sitting at 185. That's pure luck. And I'm a firm believer that we will have some stocks in our portfolio which maybe, hey, I was skill. Skill is something which we can repeat it, right? Luck is something which I can't repeat it. And of course, I do have some stocks in my portfolio in which I got lucky, and some stock in which I think I really had a skill because, the market was against it, didn't understand what the company was doing, but I persisted and I think my skill was involved. So from that concept, look into your portfolio, and next week we'll talk about one stock that you feel you benefited because of your skill, and the one stock which was, hey, it was a chance of luck. Okay. Cool. Good with that? Or if someone is already, so I'm looking at Rameshji mentioning NVIDIA, I've got just patience to hold. So I don't know if this was in reference to the skill or a luck. And sometimes you have to, sometimes you maybe you may use your skill to get into the position, and then position, the stock just ran up and you got lucky because it, it basically surpassed your wildest dreams. In that case, you just maybe just lucky. Elena says, can we talk about tax loss harvesting? So, Lena, do you have a specific question on tax loss harvesting?
Yeah, since we're like near the end of the year,
Yeah.
I'm considering doing that and try to figure out which stock to sell, not just the ones that are at a loss, but then some of those are long-term investments for me. So just curious if anybody has best practices on how they choose which stock to sell for tax loss harvesting, and how do you think about it and approach it?
Yeah, so I did, I think last week I mentioned I sold some stocks because I wanted to harvest some losses, but then I still have some because I still have some long-term outlook. Yeah, so but we can discuss in terms of various options for tax loss harvesting, but I think next week it may be already, could be late, or no, next week will be 20th.
You have till the end of the year, so we've got 2 weeks left, which is
Yeah,
not a
the
lot.
idea is you need to have a 30 days of a gap if you bought it before and now you're selling that. It's a 31-day window on it. Anyway, we can talk about it next week.
Okay, thank you.
Cool. Carvana. So Deepu, Carvana, what was it, skill or luck?
I think I got it when it was $7. It came down to $7, and I just kept it in the hope that this market should pick up. And I think in the future, kids will not like to go to their dealers, and they will just go to the showroom and then pick up the car they want. So I thought that I just believed in that concept and kept it. So it's both luck and like kind of skill as well, I guess.
$7 great buy, but I think wherever it is right now, I don't even know where Carvana is. It like 300? And it got included in S&P 500, right? That's the pure stroke of luck.
Yep, that's correct.
So you had no idea that it's gonna go to 300.
No idea. No.
Right.
And that's just bought open at $2, and I'm anticipating that open will do the same thing that Carvana did maybe in future.
Ah. Okay. I have to figure this out. So let me just look at CVNA. Yeah, 455. This stock at some point of a time, I think, was trading at $3. It was like 350, and then
Yep.
gave up all the gains, went back. It was down like 99%, and now it is back. Yeah, almost 375, then back to $3, $2.
Yep.
And now it surpassed even the previous all-time high. Yeah, I just can't wrap my head around this company in terms of, because they don't make money by selling cars, if you know what I mean, right? So their business model is not to make money by selling cars. They make money by securitizing the loans and then selling it to investors. So, but yeah, business, if you look at it from a car business perspective, the margins sucks here. But I guess they have a lot of other income. Yeah, I don't understand income from continuing operations. Anyway, that batch. So yeah, but Carvana has done good. There are, I think, only one hedge fund guy that is involved in it, and now he's moved to open doors. So I guess that's maybe a fan of that. I forgot the name of that fund manager. All right, so the new book which I started this week is David Einhorn, who is a founder of Greenlight Capital. The book name is Fooling Some of the People All of the Time. And I think this relates to maybe some short selling, etc., that David did on some company. At this time of the year, I want to take the books which are a little more story oriented, so that's why I picked it up. And hopefully, and especially you learn a lot from short sellers. You don't learn much from those who are long on the stock, but if you are someone is short the stock, they really have to do in-depth study to understand it. And I hope to see some investigative accounting concepts in it. It's always fun for me to read through that. So hopefully next 2 weeks I'll be able to finish this one. Anyone else reading any book and any recommendations for books? Maybe we should have separate book review meetings. Anyone reading any book? Politicians' Bible. Yeah, I don't know if it is related to politics. That's a topic that doesn't excite me. I am a sucker for business related books, non-fiction business related books. Even if it is, or let's say biographies or autobiographies. Okay, no other book suggestion. Common stocks and uncommon profits. I think that is Phil Fisher, right? If I recall.
Yep, it's Phil Fisher.
Phil Fisher, yeah. Phil Fisher, William O'Neill. Yeah, they have some good books. Cool. All right, let's move on. So on the TradFi side of the house, deep simplicity. Is this more of a philosophy related book, Aditya?
Very well. This one goes through how there are some fundamental principles that repeat across economics, evolution, just all kinds of things. Yeah, it's actually, I think at one point Charlie Munger recommended it. Okay. That's why I'm reading it. It's fascinating.
Oh, thank you for the recommendation. I'll add it to my list. But I guess I have a few books which is on my reading list. I have to get through that. But thanks for the recommendation. All right. So on the TradFi side, on the macro level, we had a FOMC meeting, which was a little unusual because we had 3 dissents, which I guess the highest ever. And I think the 25 basis point cut, that wasn't a surprise because market was already pricing in. We had like almost 95, 96% going into the meeting. Probability was we're going to get that much cut. And 2 of the governors, Smith and Goldsby, they voted against the hike. And Governor Myran, he also dissented. And he wanted 50 bips cut, which I think even the previous meeting, he did the same stuff. He's been recently appointed, I think the newest governor appointed by administration. So obviously he doesn't want to be sent to Gulag. So he'll want 50 basis points cut. But anyway, good to see that Jerome Powell was able to, finagle and eventually give 25 basis point cut. That wasn't important. What was more important was for Fed to come and say that we're gonna initiate reserve management, something like that, some strategic reserve management policy. Call it what you may, give it whatever name you want to, but at a deeper level, it is just they're gonna basically inject the liquidity in the market. So they're gonna buy $40 billion worth of T-bills starting from December 12th. It's not based on a set schedule, I guess. It is based on whenever they feel that the liquidity in the market is drying up, especially on the repo market, Fed will step in. Right. So 2 things have happened now. One was the ending of QT, which they already announced earlier. And now through this, under the guise of reserve management practice, kind of a QE. So Fed will start to buy T-bills. They also said GDP outlook seems to be stronger than their own prior forecast. So chances of recession seems to be, very low, even by Fed's own admission. What else happened? So the government didn't have enough of data because we had a government shutdown. But whatever data they had from there, basically Jerome Powell said that it looks like the economic activity has been expanding at moderate pace. Elevation stays up somewhat elevated. Inflation is somewhat elevated, which I think is a standard statement always. Still not at 2%. And I think there is some economic data which will be coming out. Maybe it was non-farm payrolls or something. Some data is coming out on Tuesday, and we'll see how that data looks like. But one thing which I think market wants to hear, and that could force Fed to maybe cut further, is the deceleration in the labor market. Little hawkish tone from Fed in not for this particular cut, but for 2026. I think they mentioned that maybe we'll get only one Fed cut in 2026. But who cares? Jerome won't be there. I think it's in May that they're gonna have a new Fed chairman. Right now it's Kevin Hassett, but with Trump things could change at a drop of a hat. So it's not done until it's done, until we get a final formal announcement from administration who the governor is. But right now, I think the highest probability is Kevin Hassett, who I think runs the National Economic Forum or something like that. So labor market is deceleration. So you can see on the chart in terms of changes in ADP, because we didn't have a government number. So we're basically looking at a ADP private employment, and that has changed on the number of jobs creation has been going down, and now it's on a negative. So other thing is implication for us as an investor, since we got a 25 basis point cut. So your banks will be reducing the amount of interest that you earn on your CDs that are sitting on the bank. So the yield on the cash will continue to come down. And this chart shows basically the Fed interest rate adjusted on inflation. Now these numbers are adjusted for inflation. Right. So yeah, we had some periods where we made some 2%, close to 2% adjusted for inflation. Now we are heading back down to zero. Right. So there's the cash which is sitting, which is probably not making much once you account for inflation, right? You probably still can make 3%, 4% in some CDs, not in the short term, but if you want to make a little higher, then you'll have to go at the long duration side, right? Which is maybe look at 10-year treasuries instead of looking at T-bills. But if you do a long duration, you run up the other risk of interest rate sensitivity risk. So the idea is, if you have a cash, the question, hey, where can I put in that cash? Yeah, if you go on a short term, then basically you're not making much. But if you're going a long side, as long as you don't have a need for that cash, for let's say if you're taking 5-year or 10-year treasury bills, then you're gonna make a little more on that. So 10-year yield has come from 4% to 4.2%. So you can still make 4.2% on 10-year, but it being a little longer duration, you will just be little more sensitive. It will be a little more sensitive to the interest rate changes. But if you don't really care in terms of what the current price of that bond is, all you're doing is clipping 4.2% coupon. Yeah, sure. That could be one vehicle to park the cash. And there are a lot of folks who are still parking the cash on the money market funds. Now we are looking at total $7.6 trillion still sitting in money market fund. Right, so I think the retail is 3 trillion, institutional is 4.6. So 4% coupon probably is good enough for people. Right? And yeah, if you can, we thought that so much of a cash sitting on the money market fund probably will move into stock market once Fed starts to cut the rates. But we already got 3 cuts. 150 basis points and 225 basis points. So almost we already got 1% cut, but the capital is just sitting in the money market fund. So the capital that you need for next few years, my idea is minimum 3 years, shouldn't be in the market. Right now you can still get 4.2%, close to 4% yield for your cash. But if you don't need it for next 3 years, yeah, we should still allocate it to equity market, but stay diversified. US equity, international. By the way, international has done much better this year, which is very unusual. I mean, US market have outperformed international market for almost 15 years, but not this year. This year, international markets collectively has done much better than US market. I think Korean market is number 1. It's like up 90% or 95%, which is almost double. So SPY is not bad. SPY is 17%, but if you compare it with the other markets around, yeah, we rank very low. I think I saw a chart somewhere. I don't think I have it in today's account. Maybe next week I can bring that up, which basically ranked all the country specific ETFs, which will tell you in terms of how that specific country has done. And I think the Korea was number 1. But some of these exchanges are so small that one big company can move the overall the market. Like TSM in Taiwan is really big when it comes to concentration of one particular company on exchange. I mean, we worry about that concentration here. I think that some of the other markets have way more concentration. Tom is saying, following up on the Sentinel-1, I own shares. Those are sold at 14.95. Okay, so you bought at 14.65, sold at 14.95. And maybe hopefully if it'll come down to 14.50, looks you're gonna buy it more. So yeah, I mean, I don't, Tom, you know me, I don't do short-term trades. But yeah, it worked out.
I just wanted to follow up because it was down on high volume, so I just wanted to follow up. That's all.
Yeah. So they had earnings. Was it last week or this week?
It was last Thursday night, actually, and that's why the stock sold off sharply.
Oh, okay.
It was just a bounce. That's all.
Oh, okay.
You'd gone through the Yahoo Finance and the financials, and the metrics were not very strong, but that's why it's a $15 stock. So
yeah. I mean,
I was just playing a bounce short term.
Got it. Yeah, I think I played on it when it was around 40, 45. Then I got out of when I was cleaning my portfolio. Interesting. This is instead of a time person of the year, now we have times persons of the year. And this photo got splashed over multiple places on the podcast, or I would say, right, the video cast. that I listened to. It got discussed in podcasts, etc. So I thought I'll bring this up. I think this is referencing maybe after depression when the country went into overdrive for infrastructure investments and maybe we're building skyscrapers. But so these all persons of the year are basically AI people. I don't know what does this tell us about the state of AI. I'm gonna want to take a guess. So, so we got Zuckerberg, Lisa. So I think I recognized everyone except the lady in the far right. And then I searched for who that lady is. She's Fei Fei Li, and she is called as mother of AI, the co-founder of ImageNet, basically using, you know, she's a professor in Stanford and also, um, founder of a couple of companies. But she's a pioneer in terms of using, or pioneer for developing AI to learn from images. That's why she's on this picture.
She also was at Google for AI. And she's on the circuit for a lot of different conferences because she is one of the AI experts. And I think she just was recognized too. I want to say it was in Europe by a matter for just all of her work in AI. She's pretty famous, actually.
Yeah, unfortunately, those accommodations don't generally get the recognition. And so good to see Times putting her on this list because most of the time the market will focus on the companies that are building, either if these are public, then how much of a capitalization increase that happened in their companies, or if it is a private, okay, how much are you valued? But there's been a lot of effort that goes into the basic research, which never get recognized. So good to see her being on, in this picture along with all other folks. So, but does that tell us?
My answer,
Go ahead, Sam.
time is just being lazy, and the male corporate bosses, these are all enemies of Robert Reich. Because of the pay disparity. I think time is being lazy again. I mean,
so I don't know how they pick this up, but but I have heard of something called the curse of Forbes. That when Forbes selects someone as a person of the year, or no, I don't know Forbes as person of the year, but Forbes put someone on their front page, and then it means it's a peak for that person. And obviously, it's not always true, but we are seeing in terms of Sam Bankman-Fried, Elizabeth Holmes, etc. They were all on the Forbes cover page. So there's something called Forbes cover curse. I don't know if a Time Person of the Year is also a curse or not, but we did see 1999, Jeff Bezos. He was a Time Person of the Year, right? Because Amazon was all the rage during .com. And I don't have to remind you what happened after that. 2010, Mark Zuckerberg was Time Person of the Year just before Facebook IPO. I think they IPO'd in 2011. And then we know what happened after that IPO. It was one of a disastrous IPO for Facebook. Of course, now it has quadruple or whatever, centuple. Like I think it IPO'd at maybe 17 or 35, fell down to 17. I recall seeing about there was some glitch during the IPO, and then later on there were a lot of concerns around whether Facebook be able to pivot from being an application on the desktop to being a mobile app. Kudos to Zuck, completely transformed the company. Then 2021, we had Elon Musk as a person of the year, and we all know what happened in 2022. right? So the Tesla stock got cut in half. I don't know if Tesla has recovered since then. Has it recovered from a 2021 high? Get it, let's go on a monthly basis. Barely. Yeah, it did. Right, but we are talking about almost, yeah, we're talking of 4 years. And so from the peak of 2021, and not that much gain. And if you're unfortunately you pick it somewhere over here around October, yeah, you made some money, but underperformed S&P 500. So I don't know. Does this tell us something about the AI? Right? Is there too much froth in AI now that we got all the CEOs that have anything to do with the AI now appearing on the on Times Person of the Year? And of course, they are sitting in a very precarious situation. Guys, don't look down. Don't look down. And stay tight. Sit tight here. Don't fall off. And of course, there have been and if you even this week, market just got jitters because there was some concern coming from Oracle. We'll talk about it. But market has become so much dependent on the whole AI story, and now with this picture coming up, I don't know what to think about it. What do you think about it?
Where is Apple in this?
So Apple, what has Apple done in AI? I mean, so this is the people who market thinks that they've done something in AI. The biggest concern that market has with Apple is you've not done anything in AI. Maybe that will turn out to be good in the long run. Who knows? But Apple hasn't spent money on AI. So why should Apple be in this?
Yeah.
They haven't created model. They haven't been a great user of AI. So I think that's the reason why AI is not there. Asif is saying Apple is a photographer and might be sitting on the sideline and see one of these, keep tumbling because they are spending so much in the capex. They may not be able to justify. Anyway, we'll see.
The other funny thing is like Sundar is not featured. It's the Demis
Yeah,
Hassabis.
yeah.
Google will DeepMind, and all the rest of these people are CEOs. They didn't do the work. Like there's people underneath them, but it's so funny that they swapped out. Sundar's not on this, but he should be versus Demis.
That's a good observation. Yeah, and Dario is Anthropic, but yeah, Demis is from the DeepMind guy. So, but we'll see. So, but sometimes being on, I don't know, could this be a signal that the hype has reached its peak? Who knows? We'll only get to know in hindsight. But I thought that was interesting. And when you juxtapose it with some of the other peaks, you get a little scary around it. So other thing is from bar chart, saw this interesting table from Carson Group that when Fed cut interest rates within 2% of stock market all-time highs, which we had just now, the S&P 500 has gone on to finish higher over the next 12 months, 20 out of 20 times. And basically is the data of the cut, and then what was S&P return 12 months later. To me, this seems like you can pick the data that you want to and convey the message. You can pick the data that basically conveys your message. I don't know. This may be just correlation. It's not causation. It just may be a randomness. What do you guys think? Is this cutting interest rate 2% of the stock all-time high? Has anything to do with markets going higher, or there could be something else that may be involved in here? So 1980, 83, 85. I'm looking at something more recent to see. So 2019. And then we had 2024. And if we assume that this is how the markets will behave, then I think we're still looking at another good high for next 12 months. Other chart around the concentration, I think I was just talking about it earlier, that we see so many economists talking about US market is concentrated, only Mag 7 is driving, which is, by the way, is not true. Because out of Mag 7, some of those big Mags haven't even performed this year. I think Meta hasn't performed. Microsoft hasn't done much. I guess Amazon hasn't done much. Google has done. Nvidia is okay, but 3 out of 4 of 3 out of 7 at least haven't performed. So I think that it's incorrect to say that the Mag 7s are driving. But even if we assume that that is true, looking at the concentration, top 5 companies, man, we're not that concentrated. Some of the other markets are way more concentrated. Some markets may be small, so I'm looking at some big markets. China is ahead of US. Do we have a Canadian market here? Oh, Canada is close to US. So Australia is ahead of US. Korea is Czech Republic, like top 5 companies is close to 100%. It's done. Singapore is around 65%. So concentration per se may not be a bad thing. It just depends on concern me, and I don't know which other companies are, what those 5 companies belong to in other exchanges. But in our case, I mean, they are pretty solid companies. So I'm not too worried about from a concentration perspective.
Sehar.
Sorry?
Sorry, wrong name. I put in an article from yesterday's Bloomberg that market threads in AI company in China went up 5 times from IPO, and they're saying that the industry is overvalued.
Yeah, so I saw it when the day when it was like up almost 5x after the IPO Moore threads. I mean, it's so small companies will. I'm not much worried about the smaller companies becoming 5x, 4x. There will always be pockets. There have been companies which have gone multiple times higher, but that just doesn't mean that the market is going to crash, right? Again, we don't know where the bubble, where exactly bubble will burst. Market was overvalued in 1997 also, but it continues to stay overvalued for, I think it also doubled before it burst. So if you had gone out of the market in 1997, it actually doubled before it burst. We never know. And this is more of I think academic exercise, just to rake our brains than trying to figure out what's going to happen. We have no idea what's going to happen. Right? So all we can do, and we can't control the markets. All we can do is how we can manage our own portfolio based on what we need. James saying Trump signed EO restricting the state from regulating AI. Yeah, so I did see as an EO. I think he signed an EO, but after 2 years, what happens? Who knows? And I think they also told Justice Department to start suing the states who implement AI specific laws. I think it is the right thing to do. Otherwise, we're just gonna kill smaller companies. No small company, no startup will have a bandwidth to comply with different laws of different states. right? The regulatory burden and the compliance burden will be so high that's only the incumbents, only the big companies will be able to, survive in this. So I think it's a good decision that we have one set of laws that all companies adhere to rather than trying to overburden them with 50 different laws because now you have a users in 50 different states. The question is, since it is just an EO and not a law, it could be easily overturned by a different president. This chart does not show that US market is now 60% plus value of the global markets. That is true. But I think if we also look at in terms of what's the companies and how much of the cash flow these companies are generating, then 60% may not be that bad. If we will really try to do the value of cash flow and the growth in cash flows, then maybe US companies are close to 50 to 60%. And then why not the market cap should be? I don't know. I think because on the US side, I ran through some of the data, right? I looked at the data. When we are saying top 5 companies or top 10 companies are 40% of the market cap of S&P 500, oh, that is concentration, that's bad. No, because these are also 35% of free cash flow of S&P 500. So then those being valued at 40% S&P 500, not really bad. So I think we'll have to look at both the data and then figure out if it is too overvalued or hey, these companies deserve higher valuation because they are cash generating machines. The other countries' markets don't matter. Another interesting chart wherein now we are done with December, 2 weeks of December, and this actually shows Santa Clara, geez, what I'm saying. Santa Claus, I mean, I stay in Santa Clara County. So Santa Claus comes later in December. So we're feeling a little concerned on, oh, come on, are we going to get December rally or not? Oh, this week, where the market has the jitters that it had. So have patience, have patience. And this shows the S&P index returns in December from 1950 to 2024. I guess probably it's the average. And the rally actually happens in the second half, when most of us are like not even spending time on the market because it's a holiday season, we're vacationing, spending time with friends and families. That's when quietly the market goes higher. So don't lose your hopes just yet. You might get Santa Claus rally. Right? So don't sell all your stocks right now and move into cash. I don't know if you would, but historically, second half of December has been much better than the first half of December. That's all the chart shows. From an IPO perspective, we had an IPO of Wealthfront, pretty, I would say, lame IPO. I don't know. I mean, I wasn't even tracking it. It just showed up on, I think, some news feed that Wealthfront had IPO. I'm like, okay, I know about this company, and I mean, it's a good company. What's a Wealthfront ticker? Okay, WLTH. Basically, the one of pioneers in robot advising, automated robot advising. Wealthfront is there. The other one was Betterment, and then they forced all the other regular brokerage firms to offer robot advisory services because they were getting so much asset under management that the other brokerage firms took notice of it. But yeah, pretty lackluster, guys. This doesn't seem to be a bubbly market where the IPO is only of like 1% or 4%. Did anyone invested in this or bought Wealthfront? Was tracking Wealthfront from an IPO perspective? Let me ask, is anyone interested in Wealthfront to buy the shares? No one? So it looks like this IPO just flew under the radar. Melody says, I don't know much about this company. Fair enough. So this company helps those who are new to the markets rather than you trying to figure out where you want to invest. You basically fill up a kind of questionnaire in which they try to understand your risk profile, where you are in your investing journey, and then once they understand your risk profile, then it's automatically to invest for you in some ETFs, and it'll continue to do it. I think the best part of this Wealthfront or Betterment or even Vanguard has it, Fidelity has it now. All of them have these robo advisory services. Is it automates the process? That's the most important part. And someone who is starting their investing journey now, sometimes we get scared, sometimes based on what's happening in the market. We hold back, we sell, we do all the stupid things and interrupt the compounding. But if you got 30, 40 years ahead of you, you don't have to worry about what's happening in the market today, next year, etc. Right? And Wealthfront basically will link it with your, you can have your automatic deposit going from your salary into Wealthfront account and it automatically gets invested. So basically it's a robo advisory service. So they don't have any fund manager or a financial advisor investing on behalf. Looking at the history, most of the fund manager anyway, they underperform the index ETFs, their own benchmark indices. So if you're just investing in an indices, probably you'll do good, you'll be okay. And that's what the Wealthfront does. Other good big news, I think, which did catch a lot of attention was SpaceX. The SpaceX will IPO in 2026. Let me ask another question. Has anyone invested in SpaceX through secondary share markets or through some of the SPVs? A lot of special purpose vehicles, they'll basically, some folks will pull together, someone will create an SPV. You can invest in that SPV and that SPV basically get onto the cap table of SpaceX. Anyone has any exposure to SpaceX through this?
Wait, is that true that they're going to be IPOing in 2026?
That's the news which I saw.
Wow.
And I think late yesterday night, I also saw, I think on Bloomberg, they confirmed like they're going to tender it at $421 a share, which is close to almost $800 billion.
Wow.
I think yesterday they crossed $1 trillion valuation. They were saying they'll have the $1 trillion plus 2026 they'll go IPO.
Yeah.
Wow.
So now the valuation part, I think, is a tricky one because now I am seeing on a Twitter, different experts are saying, okay, what if SpaceX become 1.5 trillion? You know how much wealth this guy Elon will have? He may become the first trillionaire, combining all the stakes in all other companies as well. So
you get exposure to SpaceX through some mutual funds, right? So Ron Barron is a big, Elon Musk fan, right? So he owns SpaceX. I don't know instruments how he owns it, but he has some SpaceX.
Yeah, Ron Barron, he's one early investor in SpaceX. He was an early investor in Tesla also. But he may be through SPV or his Ron
I
Barron,
don't know
he
the
is
instrument,
invested.
but when I look at his report, right, it says he has SpaceX in the mutual funds.
Oh, okay. Yeah, but then it depends on what percent of
Yeah, I don't know all that.
mutual fund, etc. Yeah, otherwise there are SPVs. This is where I get a little concerned is my tax guy, CPA, is now sending me emails on, "Hey, we have a new SPV for investing in SpaceX, for investing in OpenAI. Just update the Google Sheet if you are interested in investing in it." I'm like, okay, I'm not doing it. But over the last, I think, 6 months, there are a lot of SPVs being created. We saw Meta basically investing into a data center through an SPV. That was a different one. But this is, a lot of SPVs are basically, the employees who are selling us shares, SPVs were buying those particular shares. Now, if it goes to IPO, we'll see. But it might inject some life in the IPO market. One other thing which I think we probably are not in that bubble category yet, because not many of the big IPOs are happening. If you look at what happened in 2021, we are almost like 400 plus IPOs during that year. Yeah, and then for the next 3 years, IPO was a dead market. Now 2025, IPO started to come back, but not much. I mean, we're not seeing this IPO coming out and, right out of the first day, they're hitting it out of the park and getting, so much of air time, etc. We don't have much IPOs. So we have seen mostly near the peak and the bubble about to burst. Before that, you will see a lot of new companies, small companies, unknown companies raising too much of money because everyone is greedy at that point of a time. We're not there yet. What else we saw? We saw a rotation happening, and this is where, going back to my previous comment, saying, "Oh, come on, it's all driven by Max 7." That probably is not true. The Dow closed all-time high, and the value in the S&P was also at all-time high. The Nasdaq is not all-time high. Nasdaq fell on Friday. Nasdaq fell. Both of them closed all-time high. So we are getting some rotations out of AI, out of tech, into the other blue chip sectors, the financials, industrials, and healthcare. Over the last 2 weeks. So maybe there is already a skepticism about all this AI in the market. And when we have skeptics in the market, that's not the peak. If I have no idea what's going to happen in 2026, maybe we'll peak, maybe we'll not. But all I'm looking at is just trying to see what has happened in the previous cases, because human behavior doesn't change. For thousands of years, fear and greed are two traits that guide our behaviors. And I don't see that greed just yet in the markets. The way it was in 1929 or the way it was in 1999, that's just not there just yet. So we'll see. So I'm not too concerned. Not that I'm going to leverage up my portfolio, but I'm not in the camp which would say, "Oh, come on, the market is now given great 2 years and decent 2025. Hopefully in next 2 weeks, we don't crash another 5%. Then, we'll still be up more than 10%, which is up more than average." So the 4th year, come on, this cannot continue to happen. I see some fund manager, respected guys, talking about it. "Oh, we got 3 years of good gains and the party cannot continue." Who says it cannot? Right?
Vivek, do you remember the PE in 1999, what it was?
Sorry?
The PE in 1999, do you remember what it was?
Some of these big, on the tech sector, etc., was close to 50.
Okay.
And some of these companies like Cisco, etc., which crashed.
Yeah, those were very high.
70s, 80s. We're not there on Nvidia. If you look, Nvidia is cheaper than Walmart. And we say that Nvidia is in bubble. I don't know, is Walmart or Costco, are they gonna swap the potato chips with Nvidia chips? They are actually treating it more expensive valuation than Nvidia. So yeah, I'm not yet
How are you valuing it, Vivek? PE ratio or what? That they're more expensive.
Forward PE, not the current one. I'm looking at the forward PE. Let's bring that up. NVDA. Let's look at other.
Question is, why would Costco and Walmart and other staples companies are so highly valued, or the valuation, why is it so high? It doesn't make sense.
I agree.
Is there a logical reasoning for it?
I don't know. I mean, Costco, I just couldn't wrap my head around that. Costco was trading at 4P of almost 50. And it was last year when Costco continued to go high. I'm like, I can't pay. I know it's a subscription business, so I just can't say it's only, consumer staples, because they got a 90% renewal. It's a big subscription business hidden in it. But still, the goods that they pay, they have a limited amount of margin, and I couldn't pay 50. Now it is, even still it is 43. So high.
But their profit margin is barely how much? Like I think I think last I looked at was around 4 to 6% something.
Yeah, it's at the end of the day, they sell groceries and other goods, right? The margins are not high, but the idea is that they have a very consistent business, and they will continue to earn that for decades to come. Right. So overall operating margin is only what, 4%, because it's a retailer. Retailer is always a very low margin business. Profit margin is 2.96%.
Then why the higher price they are asking for? It doesn't make sense, right?
So that's what I've never invested in this. In Costco, or I can't invest in Walmart at where they are. Maybe market is saying that these guys will be able to make use of AI and reduce their cost of operations and increase their market. I don't know. And markets can stay irrational for way longer, right? So I don't know where and I remember folks saying, hey, do you want to invest in Costco? I'm like, no way. See, at the end of 2024 or early 2025, it was like more than $1,000. For me, it is still expensive. Because, come on, it's a retailer. They are not curing cancer, or, they're not doing anything which is out of, it's like, it's so technically superior. Yeah, they are managing their operations really well. So if you tell me, even now we saw Nvidia's, what is Nvidia's numbers look like? Stats forward PE is 25. Costco is like 43. Right? So yeah, I don't subscribe to the fact that currently we're in bubblish market. Does that mean that we may not get a some correction? Of course, the 10%, 20% drawdown is the name of the game. Always be ready for it. 10 to 20% drawdown, but it doesn't mean it's a bubble. Hey, markets could be overpriced, may not be bubblicious. But there's some companies may stay in overpriced or maybe in a bubble category. Overall, I think we're not there yet. And that's my thinking. Could be wrong. Only in hindsight we'll get to know. Anyway, so we saw Walt Disney and OpenAI. They had a $1 billion content partnership. Both were interviewed on various financial channels. Basically, Disney invested $1 billion in OpenAI, and now the OpenAI will have access to 200 characters of Disney, which they can use in their Sora platform, which is text to video generation. So I guess the content creator, I guess they were probably doing it anyway. And now, hey, they got a equity investment in OpenAI, and now they can legally do it. And along on the same lines, Disney sent a cease and desist letters to Google saying you're the creators on Nano Banana, which is Google's. Oh, Nano Banana does images. I think they have a video platform also. It's called Veo or something like that. In any case, the Google AI tools, if I may call it, including both image as well as video, content creators were basically they are generating content which use Disney characters in it, and Disney has sent a cease and desist letter to Google saying, hey, maybe you should license it or whatever. We'll see what happens. But that was one big news on the AI side. Broadcom had a decent earning, but then it tumbled. I think the concern is on the margins. On if you have a big customer, yeah, of course you'll grow your revenue, but maybe market is a little concerned on the margin side. What else? So Tesla falls on report on further price cuts in China. Todd Combs leave for JP Morgan. So Todd Comb was one of the two managers who managing the investment portfolio. He was also the CEO of Geico. So, but I think overall his investments haven't done that great. What Warren Buffett may be expecting. So he's joining JP Morgan. He was actually on the board of JP Morgan, because once you are at that level on Berkshire Hathaway, you get board seats in different companies. So he was on the board of JP Morgan. Now I think that's an interesting situation from being on board of JP Morgan. Now he's gonna go and manage, I think, $10 billion portfolio, investment portfolio for JP Morgan. So JP Morgan is getting into investing side, their money on different companies. So he's gonna manage that. And other one, which is IBM, they announced the acquisition of Confluent for $11 billion, which is, some of you who have been veteran in attending these sessions, we actually talked about Confluent when Confluent did IPO. And I never bought the shares. My only concern was one trick pony trying to build a business on an open source software for streaming platform. Kafka technology was, I think, created in LinkedIn, then it was open source under Apache license, and Confluent basically tried to build a business just like Red Hat built a business on Linux, right? But there are very few companies who have been able to do it really successfully. Not in any single product companies becoming that successful except Red Hat. So wasn't too keen on it, but I guess the stock probably caught the fancy of a lot of tech investors during 2021 when it came IPO. Yeah, 2021. And then probably didn't do nothing since 2022. It's been on sideways. Now this is being sold at less price than where it IPO'd. So curtains down on Confluent. Anyone own Confluent? Don't be afraid. It's okay. The stock jumped, I think, 20% or whatever after on this news.
So Vivek, I have the same question for G Vernova. Like, look at their profit margins, another 4%. The kind of business the power generation is, It's a capital intensive business. You need to invest a lot, and your recovery of your capital is like maybe another 10 to 15 years. So does it really make sense, that kind of valuation they have?
Valuation may not make sense, but that doesn't mean it can't stay overpriced. Right now, if you look at, if there was no AI, no one would have given a put on GEV. Right now, all the folks are looking at is, oh my God, we need so much power. The question is, does that also give a pricing power to Vernova to increase their margins? Because there is so much need of a power, and GE Vernova supplies all the turbines, etc. for power. Maybe market thinks that it will be. And again, market, I mean, all the, I think somewhere on the chat I mentioned, right, that
Maybe it's more of a
numbers are
sentiment.
history.
Maybe it's more of a sentiment than the real numbers
So
telling the story.
the numbers are history, and market cap is always about future. The question is now, sitting here, can you figure out, hey, this is a future in which G Vernova can charge premium because there is so much demand for it? And then say, you know what, we got to increase the margins, we're going to need more money from you and become a better business. Looks like some people in the market thinks, because there is so much demand for power, and it's a big play in power. But if you don't think that will be feasible for a long term, that's a decision you have to take. So market cap is always forward looking, and that's where the whole narrative comes into picture. And the numbers, the stats, these are all backward looking. This will tell you where so far it has been, what it has done. Market cap is what it can become in future. So that's a challenge we have. And any company that have been involved or in a big time on an AI, forget about what they've done in past. Market is like, oh, come on, this is going to be the greatest thing for this company because they are a crucial player in AI business. I think that's what is driving GEV. Another question is, will that they being a crucial point give them enough leverage, enough of power to improve margins or not improve cash flows, increase their cash flows? We'll see. I mean, I'm not investing in GEV because I don't know when the markets will turn south. And some of the companies that have gone up on narrative will come back down even quicker when the narrative when there is any crack in that narrative. So as an investor, I think we need to understand that if you're investing in it, what kind of a company in it? Is it purely driven by narrative? Have you seen the company being able to manage a business well or not? Based on that, you invest. If your investment is largely based on narrative, which there are some companies don't even have a product. Some companies have products, also they have a revenue, but it's kind of they are paying through their nose to buy the revenue. But sure, there is a narrative that the market will become so big that the current fixed investments they are doing, they will be able to spread over so much units of a future revenue that the margins will improve. But that's a visibility we need to have as an investor and see if we can see that future or not. VCs are great in seeing that future. That's why VCs are able to invest when the company is, I mean, I won't even touch those companies, but they are able to see that future, and then they spread their bets over 100 companies. Neither I have that capital nor I have that foresight. That's why I don't generally do VC investment. Right? I don't do angel investing because I don't have a capital to invest in 100 companies. So, but maybe some market might think that GEV will be able to do it better. Right now it's all driven on the narrative of AI. Ramesh is saying cost spending in areas selling car, vacation, subcontracting for home services, gold, cheaper gas, etc., etc. And I think they had a huge uptake in the sale of gold bars for all the right reasons. The gold have been the best performer in the market. Can you please share a high-level thoughts about Snowflake? So Aditya, I have not looked at Snowflake in maybe last 2 years. I mean, when it first came IPO, it was super expensive. It was trading at 80 times sales, and the overall market cap was more than the TAM that they had mentioned in their S1 document, right? So I was like concerned on Snowflake, but let's look at.
Yeah, I'm seeing still the net income seems to be a negative number, which is never a pleasant sight.
That's okay. I'm not, Snowflake is like, it's not what, 6, 7, 8 years in the business.
Right.
Right. Now the concern is, especially when it comes to the tech company, the reason why we continue to have this negative operating income and eventually everything then falls from there is because of the R&D stuff, right? Had it been a old economy company, industrial company, we would have capitalized all these R&Ds. And unfortunately, even now we don't capitalize it. If you want to, then the exercise that you need to do is break these R&D over 5 years. So instead of 1940, it should be, let's say this is 2000 for simplicity, easier on my brain. Break it into 5 years, it'll become 400, right? So
Yeah.
it means 1600 is expense for this year if I capitalize R&D. Your operating income become positive.
Right.
Right. So I add 1600 is gonna. So when I look at especially the tech companies, just that the accounting rule works in a way that you can't capitalize the R&D. But if they had bought a machinery, they would have been able to capitalize it. Now, what is R&D for a software company? It is the damn machinery, right? It's the equivalent of buying a big machines for a plant, for an industrial company. Because whatever you're doing R&D, you're basically building the software which will continue to be used, and that piece of software will continue to be used for years and years. It's not a variable expense. It's kind of that one of the fixed cost, but accounting doesn't recognize it. So that is why I'm still okay for some of the software companies to have negative operating margin just because of an accounting rules. But let's say if this has been in existence for 15, 20 years, then I will get concerned around, do you really have a product or you just keep on changing it, right? I think they are not there yet. So I'm not too worried about negative operating income, especially if we just ran the numbers. If you capitalize that, it will become positive. But overall, I still want to see, 60, this seems to be little less, 67, 60%, 65%. I would rather want to see in a software company, it is north of 70% gross margins.
Yeah.
Okay. Again, I've not looked into the company over the last few years, but little concern is that their sales growth is coming down. It's a growth story. Don't want to see growth coming down in a growth story company. That would be another point of concern for me.
I am seeing quite a bit of adoption in the wider market. I'm actually studying it right now. So it got me interested.
Yeah, but you have a Snowflake, you have a Databricks.
Yes, a lot of competitors as well.
Yeah, a lot of competitors in this space. And then of course, you can't discount these hyperscalers anywhere. Right? So you got Amazons and the Googles. Googles have their own data analysis like tools, and then you got a Salesforce which has got Tableau. So it's not that that they are operating where in no other player. It's a very competitive market.
Right.
All right, looking at the crypto market, nothing much change. We're still close to between I think 88K, 87K, and 95K. We spent almost 2-3 weeks between these. Surprisingly, we didn't. I think once FOMC announcement came, it shot up to 94K and then fell down to 88K. If you listen to the folks who are very close to this industry, they still talk about the impact of the liquidations that happened on October 10th. That is still, I think, still there a little bit in the market. Probably will take one more week. I don't know if I should buy that argument or not. Have you guys heard the logic behind what happened on October 10th? There were huge liquidations that happened in the crypto market on October 10th. You guys know why? What happened? Let me go to get coin. Try to get October 10th. 3 months. October 10th. September. That must be this. You see this one of I think the biggest one-day drop on this October 10th from 121K to almost a 10K worth of drop. What happened on October 10th? So here's a story coming from Tom Lee. Is on, and I don't know how much. I mean, he's a well-respected authority. So I think what he says is right. I would like to believe, but it's difficult to wrap my head around this whole logic around on October 10th. So his concern on October was, I think something even on the TradFi. I don't know, was there some new announcement or some stuff that happened which caused some weakness on the TradFi as well as on the crypto side. But we always see some stuff on the crypto side. But what happened in this particular case, I think maybe it was related to Trump talking about banning some crypto stuff on China or something related to it. So there was one particular stable coin, USDA, that got depegged on one exchange. When I say depegged, means generally the stable coins, the name is a stable coin because they're supposed to trade always at $1. But we have seen rarely, but in some extreme conditions, when they will start trading at 80 cents, 70 cents, 60 cents, when there is some extreme pressure. And on October 10th or maybe on October 9th, there's some announcement came. So some stable coin depegged from $1, started trading for small, not for long though. For a brief period of time, it got depegged and trading at 65 cents. Now, in mostly on the crypto, there are a lot of leveraged bets. You know, exchanges like Deribit can give you 100 into 1 leverage, means a position moved by 1%, you get wiped out. In this case, the position was down like 35%. So a lot of those leverage speculators, what they do is, you know, they'll have USDA, might have staked that USDA as an asset and levered up against that. Now the exchange that was basically picking up the value of this coin from one particular source. They saw the value got dropped at 65 cents, means all those accounts, levered account, got liquidated. So if those levered account had bought Bitcoin or altcoin or any other coins, Ethereum, go down the list, all those got sold off, because most of these on crypto side, these are automatic liquidations. And you borrow it, and once the asset goes below a certain price, your overall loan to total value ratio goes below a certain percent, it'll get automatically liquidated. You don't get margin calls like you get from a broker. If your account needs more money, broker will call you. before they liquidate it. In crypto, it's auto liquidations. And then when that get liquidated, when you suddenly see liquidations happening, you see the assets, Ethereum being sold in the market, whatever price it is, Bitcoin being sold in the market, altcoins being sold in the market, then that depresses the price of it. When that depresses the price of it, now on all other exchanges, people who have levered bets and had these assets as a collateral, now they start to get unwind. What Tom is saying is, in this case, a lot of market makers also got caught in this unwinding, and some of the market makers also got liquidated. So there's one thing, if as a participant, if me as a speculator get liquidated, but once as a market maker get liquidated, then the market takes a lot of time to recover. So that is what his understanding is. And I think Jose has mentioned that IBIT has a massive outflow, lot of background.
Like huge.
Jose, I'll have to mute you. Looks like you're driving and a lot of background noise is coming. So, but
can you hear me now?
Yeah, but we also hear the wind in the background. But go ahead.
How about it? I was gonna say, have you looked at the open interest for BTC? And if you look at it right now, the price is going up, but open interest is going down, which is typically bearish.
Price is going up and open interest is going down. Okay.
Yeah. So I mean, that's, if you want to talk about liquidations and you know what I mean, like leverage on Bitcoin, that's kind of one of the indicators.
Oh, okay. No, I mean, I don't participate in leverage bets on Bitcoin or any of this, but that's what I heard. Tom Lee saying this is why it happened. And on one exchange, once you have this liquidation, then the dominoes start falling because the asset got sold off. Then that start to have an impact on other leverage bet on other exchanges or decentralized platforms and all that stuff. So he says now probably and he likes to call it as a glitch, a software glitch, which I'm like, come on, are you telling me that a code that the platform had to pick up a price of the stable coin from one source that caused all this? All they needed to change was to look at the price from multiple sources and then take an average or whatever. And he says that was a glitch which causes liquidations. I think what he says, probably he knows what he says. It's very difficult to believe it. But Tom Lee is a respected guy, so I think what he's saying is probably right in terms of what happened. And he said we are still reeling from that effect. Now, given that, I don't really care, and neither should you. If you are in this market, it is a 10-year long bet minimum. That's what my bet is. My bet is like 15 years, and I don't care what happened this year or the next year or 2 years later down the line. I'm still looking for better use cases and adoption of these assets, to which we are getting some good news. So we have a S&P 5, not 500, but we have an equivalent of SPY in cryptosphere now, which is BITW. So I think earlier some of you have asked for, if I want to diversified portfolio of, is there any ETF? Now you do. So BITW invest in top 10 assets. And I think, again, the ratio is 60% in Bitcoin, 30% in Ethereum, whatever. You can look into the prospectus and you will know. But if you buy BITW, basically it'll give you exposure to multiple cryptos. So rather than me investing in one particular stock, I'll pick up S&P 500. And then rather than you investing in one particular coin, Solana or whatever, Cardano or Ethereum, BITW give you exposure for 10 crypto assets. It started trading this week on exchanges. But be ready to pay through your nose for the expense ratio. It's not cheap. They're charging, I think, 95 basis points. More important is OCC. Now, this is where we are seeing our traditional bankers coming in. So OCC now confirms that the banks can now engage in riskless principal crypto transactions. So I will just want to give you a break of what does that mean. That means a bank cannot buy Bitcoin and hold on the balance sheet, because then they run a risk of what if the Bitcoin goes down. But they could allow their customers to buy Bitcoin from another party and hold it for customers, because then it's a customer's money that's going on, or not bank's money. So it's a riskless for bank, and bank may be able to charge some commission for it. One sec, someone on the door. I had asked for a late checkout, so one sec, I'll have to tell them again.
Question.
No, I do have a late checkout, so they'll come back. Yeah, sorry, there was a question.
Yeah, Vivek. How many times has your electricity bill gone up since 2020? Mine's gone up 3 times.
Mine has gone up, but I have not shown how many times did it go up. But yes, it has gone up since then.
So we are paying for the data centers. So it seems that corporate has the same rates we do, so they don't get charged as high for creating excessive usage as we get charged as a household.
I don't know if we are paying for because of data centers, etc., or not. But even if we are paying, I can't change that.
No, but what I'm saying is, how many times has your electricity bill gone up?
No, like I
Mine
said,
has times.
yeah, I have not checked, but I know it has gone up. I can't help that one. So all I'm saying is, okay, I will maybe buy the stocks of the companies that are causing me here and make money from there.
Oh, yeah, that's right.
I,
I hate Comcast, so I bought their stock.
Yeah, so I can only focus on what I can control. I can sit and cry. Maybe I'll vote to get the mayor out, but if or whoever is responsible, right? But beyond that, I can't do much. This discussion doesn't go anywhere. All right, coming back to this, I'll spend 5 minutes on another. Then we'll jump onto the revenue calculation. We have to go through that. So OCC is now telling that banks you can engage in it, and the PNC Bank, they already tied up with the Coinbase. Now they have a plan to, if you're a PNC Bank customer, you basically can buy Bitcoin right from your banking interface. So that's PNC Bank has confirmed that they will allow their customers start buying it, and they're going to use Coinbase. So I expect other banks also to basically start providing this facility to their own customers, that don't open an account in with Coinbase or other exchanges, or move money there. Keep your money with me. You can buy Bitcoin from your banking interface. Why you want to move your money? So that's the play here. Much bigger. I think this is much bigger announcement. Crypto forecasts are coming out. Right, these were the Bitcoin target for 2025, and this is where it's simply futile to spend a lot of time on looking at the forecast of Wall Street people, because who knows what will be true. Forecast is just a forecast, nothing more. I've seen the same case on S&P 500 forecast. Once in a while people get it right. You'll get 15 forecasts and one of them will turn out to be right. It's just a toss of coin. I know this is a forecast from JP Morgan, Vanek, and everyone else, and we are now sitting at $90,000. Right? So don't put too much faith on other people's forecast and change your investment profile because you saw a forecast from Tom Lee's saying 250K. Now I think now he has revised his forecast anyway. So now I think now he's saying what 120, 125K in Q1 of 2026. Who cares? And I don't even know, no one has any idea where it will be. All right, jump into our last topic. Ramesh, I've sold $40 through 48 IBIT put. Okay. Yeah, IBIT is a good instrument. I mean, I made a lot of decent premium on IBIT. Apart from my hedging trades, the most number of trades that I've done probably is on IBIT. Okay. All right. So let's get on to break-even revenue and valuation. There's a link to the Substack if you want to go through this. We'll share that in the chat. But basically, this talks about, I mean, the whole discussion started from looking at a $1 trillion companies, right? $5 trillion market cap, which NVIDIA hit. On intraday, it was a $5 trillion company. So Professor Damodran, he went back and looked at all the market cap milestones and, see how things have evolved. And the whole idea was to see, are we, is it just, are we smoking something that is saying, hey, could it even be justifiable? $2 trillion, $3 trillion, the companies that we have now, $4 trillion NVIDIA, is it not justifiable? Is there a path towards it? Right? And if there is a path, then what's the break-even minimum revenue that they need to generate to justify that valuation? So that's the whole concept is. So looking at different market cap milestones, we had a first billion. I love going through some of these financial histories, so bear with me. First $1 billion corporation was US Steel Corporation in 1901, right? And then I think we had a $5 billion 1950. It took almost 40 years. The first time we had 1945, almost 44 years for any company to move from 1 billion to 5 billion. And I can understand, I think we had a go-go's of 1920s go-go year. And then 29 to 33, we had a crash. And then later on, we had the World War and all that. And after that, 1945, we had Standard Oil, the big giant Rockefeller hit $5 billion. Then we have GM hitting $10 billion. And so on and so forth. Coming back to Microsoft, 1999 was $500 billion. That was the first company to hit $500 billion market cap. And then it was all Apple. 1 trillion. This we remember. This is pretty new. 1 trillion. And we used to wonder, come on, it's $1 trillion. How much more can it grow? Right. And then Apple continued to grow till $3 trillion. Right. And then we got NVIDIA, which was basically $4 trillion, 4.5, and now $5 trillion. But if you look into the pace at which NVIDIA has grown, right, it's amazing. Like from July to October, they added $1 trillion. Whereas it took us almost 1901 to 2018, 115 years, almost 117 years to add $1 trillion. And then it took 5 months to add $1 trillion to NVIDIA. This is a little difference, which he talks about is in the type of the companies that have been hitting these high cap milestones in 20th century. These are the companies where the best days were behind them. They're grown, they become mature, right? But they'll be able to consistently, maintain where they are right now and give you dividend and all that stuff. In 21st century, the nature of the companies have changed. 21st century, as an investor, we started looking more into the forward side, right? What's in future? And we started to give more valuation to those companies. We started to reward those companies which we think will do better in future. And that's why you'll see all these companies not that NVIDIA revenue has grown up 25% in a quarter, but the market cap has, because the story had changed. Right? So looking at another chart was in terms of US Steel. How old was it? US Steel was right out of the gate was $1 billion. GM was like 47-year-old. GE was 100 years old when it hit $100 billion. And the revenues and then their net income. Right? Let's talk about concept of break-even revenue. So break-even revenue, like I said, is a now Professor Damodaran doesn't talk about Michael Mauboussin, but these are my own notes. It's a similar to the reverse discounted cash flow that I had shared with you earlier for some of the other stocks. And then it's also been not explained in this term, but this is what expectation investing Michael Mauboussin talks about. But it looks at the revenue instead of free cash flow. Right? Now, Professor Damodaran, he uses intrinsic value framework to estimate the revenue required to break even at this current market cap. If you are a $5 trillion or $4 trillion, what's the revenue that you might need to break even at this? Because that's at the top level, right? Then you take down your COGS and cost of goods sold, you go to gross profit. Then you take down your operating expenses, come to operating income. Then you take away taxes and interest and everything else. Then you come to the net income, right? And that's where you have to take all those to get to free cash flow. But the source is revenue. That's at the topmost level. So what Professor Damodaran wants to look at is what will be the revenue that may be required to justify or to break on this $5 trillion, $4 trillion, right? So basically they're looking at this intrinsic value. Value of equity is revenues into net margins, plus you need to reinvest. And then how much is your cost of equity? Now you know the revenue here. You basically solve this mathematical equation. You have a value of equity is $5 trillion. You know the margin, you know what's the cost, etc. You basically solve for this revenue. That's exactly what the revenue, break-even revenue is calculated for. We don't have to calculate. He has done the calculations. I'll share with you, but I'm just sharing with you the base concepts. Now, NVIDIA at $5 trillion current revenue market cap or whatever. Right now, maybe it's $4 trillion, $4.5 trillion. Assuming that the company can maintain its net margin, which is pretty high, right? I think it's around 40s. And return on equity, and then you estimate the break-even revenue, it's about $420 billion. So they, to justify $5 trillion market cap, they should have $420 billion of revenue annually. How much, and given the fact you're looking at how much a return on equity and how much growth and how much margins they have, right, in terms of net profit margins. So NVIDIA revenue is what? Annual revenue. We are at close to, let's say, $200 billion. Right? So not there yet. But if you wait for 5 years, and time is money, so if we have to wait for 5 years, the equity investors would demand around $600 billion of a revenue, because now you need to produce more in 5 years. Right? So this is not, so this is how you calculate in terms of today, how much revenue you're doing. But if you're not having that 5 years, if you are maintaining the same margin, etc., in 5 years, will you be able to generate $600 billion? And then you estimate, is it even feasible? Is it even possible? It's not line in the sand discussion. It's just to give you a framework on, gosh, am I just believing in a fairy tale? This valuation is fairy tale, or is there any possible way, plausible way that can be achieved? It may not be easy, it may not be straightforward, but there may be use case in which, yeah, I think it may be feasible. Then the $5 trillion may not seem to be a dream anymore. So once you solve for this equation, you get a revenue, then you analyze it using a 3P framework, which is it possible? Right? Possible means, come on, the market has to be big enough, right? The AI market has to be more than $600 billion for NVIDIA to make $600 billion. Because of course there will be other competitors. Right? But let's say we come up and say AI market itself is $300 billion, then this is just a fairy tale. Then there's no way NVIDIA can do this. Right? So that's how we look at a possibility. Right? Do we have enough market? Right? This could happen, and when you say possible means, I think this could happen, but I have no idea how it will happen. I don't even know, what it is. Now then look at a plausible. Is there a pathway that you can see for this company? Is there a path for this company to do it? Has someone else done it? Has this particular company done in new spaces in the past? And then third, you look at it, is it even probable? Right? Now, as you go over this 3P framework, you move from being it impossible to higher degree of certainty. Now these will determine in terms of how you want to allocate the capital to any company. So if it is still sitting at a possible side because no one has done it, the market cap is small, but maybe it could expand. In that case, you might want to say, you know what, maybe I'll allocate a small amount of my portfolio to this. If it is plausible or probable, you may want to then increase your allocation to your portfolio. So you can use this framework in whichever way, either to pick up investing thesis or completely drop it, or just manage your position sizing based on where on this possible to probable curve does the company lie. Okay. So probable is likely to get there because you see a path. So this is where the interesting stuff is. Let me make sure it's not an eye chart. Okay, so he did a $1 trillion company, picked up all the $1 trillion companies, picked up the current market cap at 20th November, picked the margins, revenue, growth, all the numbers of this equation. And then at the end of the day, calculated what's the break-even revenue as of today. Like NVIDIA should be generating $420 billion today. And what's the break-even revenue if you want to wait for 5 years? Because equity investors will say, okay, looking at your return on equity, what I can get somewhere else. If I get after 5 years, at least you have to give me more than that, match that. The time is money. So NVIDIA need close to $590 billion. Apple need $1 trillion break-even revenue, Alphabet, so on and so forth. Right? Now, before you think, oh my God, NVIDIA can make $600 billion or Microsoft can make $900 billion. Other thing to look at is avoid this big market delusion. Because when you're looking at an individual company, it may be possible. But it also has competitors. Will it be possible along with all the competitors in the same space that they all can become achieve a break-even revenue? All of them, it may not be possible. Right? So this is what, if you read his paper that he wrote maybe 25, 30 years ago, along with someone, other gentleman, the paper is called Big Market Delusion. I think I reviewed that paper in one of our meetings, so I'm not going to go through the detail of it, which basically tells about anytime there's a new technology, we all collectively are delusional. Individually, at an individual company level, we are rational. But collectively across the sector, we might become delusional. Example, let's say a market. There's a new AI lawyers, AI scribe market. I think Harvey, or there's some product on which help lawyers write their cases using AI. Say it's $100 billion market. And I don't know if product name is Harvey. Someone please fact check me if the product name is Harvey or not. I thought that came into my mind. I thought it's a Harvey, but let's say product H. Let's say there's the founder of product, the company H is there, and we are looking at, I think, yeah, they can get to $100 billion. But then there is another company C whose founder is also pitching to another VC or me as you as an investor, and you're looking at, I think there's a path to $100 billion, and so on and so forth. All of them are individually making very rational decision. I can justify about looking my company, oh, I think that in the past they have done this, but I think collectively, you and I know it's not possible. Not every one of them will be able to do it. So avoid that big market delusion, which will become victim to, and then see if it is still probable or not. Now, coming back to this chart, this is where I found very interesting. NVIDIA needs to grow their revenue by 25% for the next 5 years to justify $4.3 trillion of market cap. Now, if you go back and look at NVIDIA, where is NVIDIA? Oh, this is NVIDIA, right? Will they be able to grow their revenue at 25%? Doesn't seem out of the bounds, right? Doesn't seem to be, now it moved from, it's not impossible. It is plausible. I think it may be probable also. Now we start to look at in a completely different angle when I'm thinking about NVIDIA. Instead of just getting bogged down by, oh, 4.3 trillion is a very big number. There's no other company in the history have been at $4.3 trillion. So it has to go down. That may not be the case. I mean, it could still go down, but trying to put some rationale behind it, 25% growth may not be too, it's not out of bounds. It's not like, there's a decent probability that NVIDIA will be able to achieve 25% growth rate in revenue for next 5 years. This is a path that we can see. On the other hand, Apple growing 20%, that to me seems little tough unless they can get fix Siri or add AI and all that. So that's a framework you need to think through. Yeah. In terms of looking at, rather than getting bogged down by these big numbers because we haven't seen these big numbers, and then thinking, oh, this is overvalued, etc. See, even if there is a path to possibility or plausibility or probability in which these numbers may be okay. So that's basically, instead of looking at like reverse DC, we look at what cash flow growth is current market price, current market cap is pricing in. In this case, we are looking at what's the revenue that will company may have to generate today, or if 5 years later to justify the current market cap. I really like the concept. Probably I'm going to incorporate it. If I can find the numbers, etc., maybe would like to incorporate in calculations when I'm trying to look at not just the reverse DCF, but also the break-even revenue. And revenue growth doesn't seem to be too. I'm concerned about Tesla though. But Tesla doesn't. So this framework is on intrinsic value. Tesla runs more on the narrative. But now it will tell me if I'm investing in Tesla, I'm only investing based on the narrative in Tesla. The number just doesn't justify, and I'm going to position size it accordingly. A narrative is driven by one person. So what if something happens to that person? The stock gonna get hit. So that's how you use this framework. to
Hey,
look.
Vivek, quick question. So, like, if someone is heavy on Nvidia, like we just talked about, do you suggest taking some of that table right now? Since like so many things happening right now, or do you suggest keep it?
Without knowing what's your need for money is, I can tell. But let's assume that you don't need cash or to pay your bills, etc., for next 2 years. If the only concern is should I sell Nvidia because I think it is $4.5 trillion is already too big and there are some concerns. I don't see those concerns just yet. So let's talk about what happened in the market this week. I think this was the last talk. Okay, I'll just go through. So we'll come back to this and we can discuss a little more detail on this one. But let me just finish a couple of things. So hold on to that. Fear and greed index didn't change much. Year to date still fine, right? Been a pretty great year.
Maybe quick question. How do you calculate the greed index? You know that.
I don't have. Come on, I don't have. Why CNN has already done it. So just Google fear and greed index. I just take a screenshot every week.
Thanks.
They've also given the 7 factors that impact it. So you may want to go look into what this, how this calculated. Okay. Stocks buys and sells. I bought 3 stocks. Again, no recommendations, but I want to be transparent in terms of what I hold in my portfolio. And I sold none. So I bought Aristonet. I just refilled the tank. There is some weakness, so I bought it back. Same case with SE. I had a put spread which was in the money. So closed that, bought some shares, and Mercado Libre closed put spread, bought the shares. Didn't sell anything. All right, let's now get back to oops, where was the chat window? Oops. Okay. There was question on Nvidia. Yeah. So if you're getting concerned in terms of, oh my God, the Nvidia may be too richly priced, and and that's why I want to sell it. I am personally not selling Nvidia right now, but I do a strangle on Nvidia. That means if it goes above, I think strangle is what, 205 or somewhere by January. Yes, little bit quantity from my portfolio will be sold. And if it goes below 165, I'll buy more. I have a short put on it, right? So I have basically strangle on Nvidia, but I'm not selling Nvidia right now just because it's at this price. It's at whatever current market. But of course, I don't. Whenever you're trying to take a decision when to buy or sell, you also need to know how much of the risk is on Nvidia of your overall portfolio. Are you able to sleep well with that portfolio or not? Nvidia is not a big position in my portfolio. I think it's less than 3%. Even if it goes to 0, I'll be able to sleep well. But that may not be the case with someone else whose 40% is Nvidia. So I really can't tell you whether someone should buy or if someone should sell or not, because I don't understand what else do they hold. There are a lot of decisions that will go in. Decision making needs to get into for that.
Sounds good. Thank you.
But just from a valuation perspective, because the decisions will account for a lot of other factors than just the valuation, right? So sometimes I might just sell some shares because I need to raise money to pay bills for next year, right? But if I had another W2 income coming in, maybe I'll not do it. Right? So those are the factors which I'm not aware of. I will sell just to sleep well. Right? But from valuation, I'm just not too concerned right now. Okay, last December, carefully said NVIDIA has deep trenches, exponential. So NVIDIA still has, I think, deep moat around it. You should also go and listen to this guy, Gavin Baker. He invests in public market as well as private market. He has some good authority on AI. And he was on whose podcast? Gosh. Invest Like the Best, the Peter Shaughnessy. I had heard Gavin Baker's interview on other podcasts also to understand this space. So if you are interested in it, don't listen to stock market commentators on Bloomberg or on CNBC. They don't understand space. Don't listen to me. Listen to the people who are experts, then decide. Listen to Gavin. He understands this space. He's been an investor in terms of what's happening in this AI space. Okay. James, the value of dollar decreased proportionally during the same time, more QE. Yeah, $10 trillion. Of course, all that factor goes in, which is dollar printing, inflation, the value of $10 trillion has come down, but still, it's a big number. Dave, where do you see Oracle in the break-even revenues? So I think he did only for $1 trillion companies, because $1 trillion people get, oh, come on, it's $1 trillion. How, it's a too big. No, it may not be big. I think that's the point that he was trying to look at. He was trying to justify, don't get bogged down by these big numbers. Probably it's justifiable. They can grow their revenue into it. So Oracle is not there. Look, Tesla is 85% growth needed, but Tesla is not. Tesla has always run more on narrative, right? Aditya, new memo from Howard Marks. Yeah, I read through the memo. Everything in the memo is good except when it talks about conclusion, because he's again, I mean, even Howard Marks can't predict that we're in bubble or not. And he's given the same conclusion saying, yeah, stay invested, be diversified. We don't know if it is bubble or not. I can't tell you. No one can tell. Even I can't tell, right? So, but it's a good memo from an investing psychology perspective.
Yeah. Just one interesting thing that I felt after reading a summary of it was that if AI doesn't end up being a bubble, and if it is a transformational technology, it'll be the first transformational technology to not be a bubble.
Okay.
That was interesting to me.
Yeah. So but I can't say that we will not have a bubble in AI. Then we are not humans.
Yeah.
Then we became rational people.
So if I was a betting person,
no, then it means every player in the market is very rational, devoid of emotions. It's only machines who are making all the decisions, which is not the case. I think we will reach at some point of time where we will see, oh, come on, my neighbor made money, double the money, because he invested in some AI stock. And we will start to, and we will see these IPOs going out, right out of the bat, they're up 50% because they have AIs in it. I don't think we are there yet, but I think we will get a bubble. We always had a bubble since, I think that's what Howard Marks says, that it will be first time that we'll not have bubble. Because we had that when we were in 1600s in the canals, right? We had a bubble in the market that time.
Yeah. No, so that's very interesting.
It is definitely going to be first time, but I'm not hopeful that we will not have bubble. We will have it, but the idea is we'll not know when we'll reach that peak and when the bubble will get break. So I'll be ready in terms of make sure that I have a cash that I need to survive for next couple of years. Always.
Yeah.
The idea is not to avoid it. The idea is not to avoid the volatility, because then you just buy the T-bills and sit tight. And then we'll wonder after 20 years what the heck I did with my life. Why I can't afford the things that everyone else is able to. The idea is to figure out how to survive through the volatility rather than avoid. So, and we will have this bubble. It will burst. All we trying to focus on how to survive when the bubble bursts. All right. With that, I think now some charts, etc. We can talk about it. Or was there any other question? Oh, there was a BOJ question. I was looking at my note. So BOJ rate hike, I think this time we may not get that reaction that we got in August 2024 when the whole carry trade blew up. Because we already know that BOJ is going to do that. Market will already, I am assuming market will figure this out, will basically start to price it in. in terms of BOJ do a rate hike, and then the whole trade of buying cheap yen and investing in US equities may not work. And if the market goes down 4 or 5%, so be it. But I personally don't think that is going to be a huge reaction, because we know that BOJ started to do it. Last year, it was first time that BOJ, after decades, decided to actually hike it. It was a kind of a shock for the markets and the participants. But if it happens today, and if I don't own much of a Japanese exposure or Japanese companies, it'll give us a good buying opportunity to buy some great stocks at discount. But I don't think we'll get a opportunity like we got in August last year, when the yen carry trade blew up.
Sounds good. Thank you, Vivek.
The Japanese market has done better. I used to do EWJ, then I didn't do it. I think over the last 6-7 months, maybe I'll look into EWJ again. Race is an opinion. How does this comparison compare to the reverse DCF that you already use? The trade-offs. Yeah, so I was thinking, so now when it comes to reverse DCF, I'm just looking at, okay, how the past 5 years of cash flows have done, and can it maintain the same cash flow or not? So it means all the assumptions that I've had from the top line all the way to the bottom line needs to be true. Right? Because the cash flow is after that you have a free cash after accounted for everything else, then capital expenditures, and then you come to the free cash flow. So a lot of even if I'm not assuming it, there is a lot of implicit assumptions that get included in a reverse reverse DCF. But I'm looking at the revenue, I'm talking about the top line. Right? And it's like if the water start to dry up at the top of the waterfall itself, there is no more water left at the bottom, right? When I'm looking at a FCF, I'm looking at a very lower levels of the waterfall, whereas the revenue will be at the top level. So I think that's where I think it has got some additional value it, because let's say if I assume, and if I run this run this revenue breakdown, I'm looking at, this much of revenue doesn't even seem possible. Then my reverse DCF might be, come on, it might be a smoke and mirrors on the reverse DCF. So that's what I thought. I thought I will also start to have this just as a criteria, just as again, I'm not going to decide just based on this. These are just the data points to look at and try to see. I don't think this is, just try to see if it is, at an extreme level. Right? Oh, come on, the break-even revenue seems to be something which is like, it needs the company to grow at 50%. That may be a little bit of a concern, because you'll have a competition coming in, then you may not be able to grow 50% anymore. So, sorry, I don't have a very fixed answer, but I thought it added a value because now I'm looking at a very top level. So fewer assumptions at that point of time. Satish, how can I receive early alerts about merger and acquisitions? There a central place. M&A.
Vivek, not only that, even the events, all these things, is there any tool or a website, a centralized place where I can get all the details or set up alerts?
I have not done it. Has anyone else done this? M&A, etc. I don't know. Maybe you can do a Google alert. Use a Google alert, which basically scrape for these keywords and send you an email.
Okay. But otherwise, you haven't heard about any single website which provides all these details?
No, I haven't even tried to look for it. Maybe there are some.
Okay.
Yeah, but I haven't even looked out for it.
Thank you.
Cool. All right. Anything else, or we could look at some chart. Oh, I have only one. I think this I'll cover maybe the next week. Learning from mistakes of others. Any other topic, or shall we open the breakout rooms?